So one of the hot topics that we talk about all the time right now is risk and assessing risk in today's portfolio analysis. We really like to sit down with our clients and make sure that they're taking the appropriate amount of risk for what they're feeling. We talk about risk tolerance all the time in our classes, and I would say it's safe to say out of 100 times, 99 out of 100 times, people when they come in, their risk tolerance doesn't match the way that their portfolios are allocated.
It's really important as you get closer to retirement that you start to do an analysis on your current risk tolerance and to make sure that it matches your overall risk. So one thing we do with our clients before we make any investment recommendations is sit down with them and go through a real risk tolerance questionnaire. Most people who come into our office have never actually had this done before or not in the detail that we like to go through. So it is important to make sure you have your risk score number, which we post on our website, that you can take the questionnaire yourself as well.
I'll give you a perfect example. The last 10 years, the markets have been fantastic. It's been real easy to grow money over the last 10 years. And we see clients all the time who will tell us that they're in a 60-40 stock to bond portfolio. 60% of their money sitting in stocks, 40% sitting in bonds. Well, if you haven't rebalanced and reallocated your portfolios over the last 10 years, that 60-40 stock to bond portfolio may now look like it's an 80-20 portfolio or even 90-10. All right, so what happens when the markets get clobbered like we saw back in March of 2020 when the pandemic hit is we see that people who aren't rebalanced are getting hit the hardest with the biggest drops in the market.
One of the things we always like to quote Warren Buffett, and one of our favorite sayings from Warren is, why risk something you have for something you don't need? Think about that. Why risk something you have for something you don't need, right? If you can de-risk your overall investment portfolio and still meet your retirement goals, is that something you'd want to achieve? Most people would say yes. And then the question becomes, well, should I de-risk, and what does de-risk looking like? So again, we urge you really to go get your risk tolerance, go on our website and do the questionnaire yourself if you'd like to, or give us a call or shoot us an email if you want to come in and get that risk tolerance done. We really think in today's current market condition with volatility where it's at, with inflation in the news and Russia and Ukraine and all of these other things that create a lot of market noise and turmoil, it's important to know how your investments might react to market downturns.
Yeah, that's a great point. It's funny, we quote Warren Buffett quite a bit in our office. And Warren has another one. He says, losses hurt more than gains help. And we use that one quite a bit. Losses hurt more than gains help. So if you do the math, we actually had a 30% market decline over a 3-week period back in March of 2020. If you lose 30% of your portfolio, you don't need to gain back 30%. That's a misnomer. A lot of people get that incorrect. Well, if I lose 30%, all I got to do is gain 30%. That's not the truth. If you lose 30%, you got to gain 43%. So the math is minus 30 plus 43 gets you back to zero. So losses do hurt more than gains help. You take that and factor in taking any withdrawals and the numbers get even bigger, which is why it's so important to have your risk of your investments measured to make sure that the investments that you're in are appropriate for the amount of risk you're willing to take on.
So I hope this video was informative. Again, go on our website, shoot us an email or a phone call if this is something you want to take advantage of.